Mr. D.K. Joshi, Chief Economist at CRISIL, with us on the show. Mr. Joshi, just want to start off with the fact that the inflation numbers did cool off this time around. The CPI as well as the WPI print were fairly encouraging, but does the fact remain that it was solely on account of the food prices and that it was only an aberration, not here to stay?
Well, yeah, I think you're right in the sense that the scare that was created by high inflation was essentially originating from food, and the bump up in food prices have now neutralized. So you're back to the previous trend. I think my sense is that going ahead we'll see inflation cool off next year a little bit from these levels. I think primarily because this year's monsoons, part of it will play out in 2014, or the first half of 2014, as the Rabi crops come into the market. And also I think if the global crude prices stay soft, I think there should not be much upside to the inflation. But the issue is, I think from an interest rate perspective or from an RBI response perspective, we do not have much clarity as yet, because the monetary policy framework is yet to be out. I think that is going to define what inflation metric the central bank is going to follow and what is their comfort level and so on and so forth. So I think unless that is out, I think it's difficult to get a clear picture on interest rates next year. But I think the positive elements definitely are that the fiscal deficit appears to be reined in. I mean, at least that's the news that we are getting. I think which means fewer borrowings, and I think so the yields have already started softening and could soften a little bit more by March 2014. I think the lower inflation is also good news from the bond perspective. So I think some downside to the 10-year G-Secs is what we have been factoring in for quite some time now.
We'll talk more about the bond yields, but, everyone had said that, the fact that the core inflation number remained high, that perhaps now the Reserve Bank is going to remain in pause mode. Would you concur with the same?
Well, I think central bank could remain in the pause mode, because if you look at the industrial production, I think it hasn't picked up. I think if you analyze industry since, let's say, July 2011, I think it's been just hovering around a very low level of growth, and there's been no decisive upturn, and there is weakness clearly, I think, as far as industry is concerned. So I think the core inflation, again, I think the confusion starts because if you look at WPI, the core inflation is relatively benign, and in the CPI it is above 8%. So I think, as I said, we need more clarity on what matrix the central bank is tracking before we draw conclusions on where the interest rates will move from the central bank side. But I think what is definitely clear is that the surge, I mean, even if the core inflation picks up a little bit going ahead, I think the surge is unlikely because the demand is extremely weak, I mean, at this juncture, and the consumption demand is only very moderately picking up.
Most market participants that we spoke about a benign first 3 months of the calendar with regards to the bond markets. However, there is this OMOs worth 10,000 crores on 22nd Jan. Your view on the liquidity situation, and how do you expect yields to play out over the course of the next couple of months?
Well, I think we have a forecast till March 2014, and I think which is 8.3 to 8.5. That is the range in which I think we think the yields will settle by the end of March 2014, and I think that's premised on the fact that the liquidity. I think the central bank there are some liquidity easing measures which they might still undertake, because the steps that they had taken when the rupee was depreciating at a very fast rate, which was to tighten liquidity, they have not been completely unwound. So whatever is left might get unwound in the coming months. So that will create a better liquidity position, and I think as far as the yields are concerned, we do see further downside from these levels by March 2014.
Take us through, Mr. Joshi, what you make of the announcement of RBI for OMOs worth 10,000 crores on the 22nd of January, as well as your assessment of the overall liquidity situation.
Well, I think overall liquidity situation will remain comfortable in the sense that the demand for from the industry or from the corporate sector is not that high at this juncture because the economy is on a weak wicket. And if I think it partly depends on the kind of measures central bank will take on the liquidity front, and our sense is that liquidity will remain comfortable. The only issue here is that the central government is spending less, and I think if they really crunch the fiscal deficit down, I think then they could end up with cash balances with the RBI, and that could be a little bit drain on liquidity. But otherwise, I think we foresee comfortable liquidity and slow credit growth in the rest of the fiscal.
What about the core macro? How do you expect the IIP and the GDP numbers to shape up as well?
Well, IIP has become nearly impossible to forecast. I mean, as I was pointing out, I mean, if you look at the chart of monthly growth rates, I mean, you find it going up one month and going down the second month. So there's no clear trend. It's just oscillating around a very weak base. My sense is I think IIP will in the fourth quarter of this calendar year look much better or slightly better, not much better than rest of the fiscal. Partly because I think we will see the rural demand play out a little bit. Let me make an interesting observation here. I think we were analyzing the IIP data, and what we found was that within the industrial production, the sectors that are linked to exports, like textiles, etc., I think if you club them together, they are registering a positive growth, and they've been showing an uptick. So the export growth is not benefiting the entire industrial production, but it's benefiting a part of the industrial production, which is beginning to look up. The second part of IIP, which is mildly looking up, is electricity production or segments where I think some debottlenecking of mild variety might have happened. I think what is not doing well as far as the industrial production is concerned, the sectors dependent on domestic demand, I think they are all looking down, and the weakness is more than offsetting whatever positive trend you are seeing in export-linked industries and also where policy becomes relevant, like mining, etc. So I think overall industry continues to remain weak. So I think.
No, my question is from the looks of it, from what industry captains are saying, that domestic demand could remain weak for the foreseeable future, the next 6 months at least, if not more.
Yeah, so I think essentially the kick will be from the global demand, because I think there's a widespread belief on global economy picking up as we move deeper into 2014. Particularly the US economy is expected to do much better. So I think if the global economy inches up, I think that will create some lift for export-linked industries, which are, I think, like textiles or pharmaceuticals, ITS also, that though it's not a part of industry. So I think we will see partial support from that side. And from the domestic side, I think rural consumption is what will cushion, I would say, industrial growth a little bit for a few sectors, low-end FMCG or even things like two-wheelers, etc. I think beyond that, the bulk of, I think, the demand will remain weak because there is income uncertainty. The incomes are growing at a slow pace. GDP is weak. So I think all that is playing out in the bulk of for the bulk of industrial sector. Except for a few sparks here and there, I think the overall industry is in a bad shape right now.
Mr. Joshi, thanks so much then for taking time out and joining in with your assessment as to how the macros are likely to shape up and what your expectation is from the next RBI policy, which is next week.